Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Shares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Shares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Shares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Ryan Newman, how are you going?
I'm great, thank you, Owen. How are you?
I'm good, mate. Thank you for coming all the way into the city. The big smoke.
It's a bit of a venture.
Yeah. Today we're going to be talking about 3 ASX shares for exciting growth, but we're also going to talk a little bit about some of the ways you go about investing and so on and so forth.
Let's do it.
Yep. People who don't know, I know you pretty well. We're mates, but you are also the Director of Research at the Motley Fool Australia. So for folks that don't know you as well as I do or what that means, what do you actually do day to day?
Okay, so well, as you said, we did actually grow up together, didn't we? Back at school. So
growing up. Yep.
Still growing up. I've known you for about 20 years. We actually both sort of started off at the Motley Fool around the same time. Really sort of learning the chops at that point, and I think we were both sort of getting into finance at the same time together. But I suppose since then I've really developed that love for investing, that love for companies. And that's what I do most of the day, I would say. Just looking into different businesses, different business models, trying to understand the opportunities that are facing each of these businesses and which businesses we can therefore invest in for ideally market-beating returns. As the Director of Research, my additional responsibilities are also to, I suppose, manage the team's resources, the investing team's resources, making sure that everyone has what they need to be doing a good job, the services have what they need. And I should say as well, I do also manage 2 portfolio services. So I manage Motley Fool Pro and also North Star, which are both growth-oriented portfolies. Okay, so you're the perfect fellow to talk to about these companies today. So yes, we have known each other. I didn't realize it was for that long. Time flies.
It does when you're having fun, which is what a lot of investing should be. I feel like you should enjoy what you do. And I think the Motley Fool has always made that really fun and obviously rewarding over the long term. So I've got a few planted questions here for you, my man. The first is, because you do so much of it, why do you like stock market investing?
Look, in terms of the opportunities in front of investors, in terms of the different asset classes you can be investing in, I suppose, first of all, I would say I love the narrative behind companies, behind the ability to actually invest in these businesses that you can understand, you can learn from the ground up, and then actually invest in their future. Look, you can do that with different asset classes, but not probably to the same extent.
Can you give us an example of what you mean by narrative?
Yeah, so by narrative, I mean, I love to understand where a company comes from. For instance, maybe the original problem that this company was trying to solve in the first place, but then also how it's evolved.
Yep.
So a company like, let's go with a company called Xero. You and I are both familiar with Xero. I also do own shares in Xero. But it started off as basically an accounting platform, pure and simple, an accounting platform, but based on the cloud. The idea was that a lot of the software that accountants were traditionally using was very clunky, very hard to use, and Rod Drury, a New Zealand-based bloke, decided to come in and actually create this platform from the cloud, from the ground up. Over time, though, this company has really evolved to not just provide that accounting service, but also to provide, I guess, payroll services, payments as well. It's really become that small business platform. So what I mean by narrative is just understanding where it's come from, where it is today, and then therefore where it can go in the future as well, as it exercises the optionality in front of it.
Cool. I like it. Good example, by the way. Numero 2 that I had here is, what's been your biggest mistake and what did you learn from it?
This is a doozy. And I want to say I actually like both companies today. So this is going back about 15 years.
Okay.
So I'll just preface that by saying that. But what my biggest mistake, and this still plays on me, I was invested in 2 companies. One was Codan, which trades on the ASX ticker code CDA.
Yep.
The other one was Corporate Travel Management. CTM is the ticker code.
So they both involve C's in the ticker symbol.
Yes. Nothing. Yeah, that's just coincidental.
Okay.
Either way, one day I was at work. I wasn't working at the Motley Fool at this point. It was well before then. But I noticed that Codan shares had dropped by 50% on this day. And I didn't even look into why. I was just like, wow, okay, I like this company. It's down 50%. I need to buy more. So what I did was I actually ended up selling my corporate travel management shares to fund the purchase of more Codan shares. Now, I think a lot of listeners will recognize the immediate flaw in that thinking. Remember, I was young. This is a long time ago, but I really did. I cut my flowers and instead watered my weeds. Turns out Codan had undertaken it was a pretty big hit to the business. I can't remember the specific details, but I think there was a fair bit of conflict maybe in Africa, which is one of the company's major markets.
Yeah, it was.
Yeah, and it took a real hit this day. I bought shares in that and only to watch Codan shares continue to decline. Meanwhile, I'd also sold my corporate travel management shares and they instead rallied. Now, that's not to say that I'm purely focused on stock prices whatsoever. That couldn't be further from the truth. But at the time, that was one of the lessons that I learned. Don't water your weeds and instead water your flowers.
So yeah, corporate travel's up from like $3.
It was probably about $2.50 or something at that point.
Yeah, and it's now like $13. It's paid dividends along the way.
Yeah.
But I must also call out that Codan, after that massive drop, I remember it went from $3
to about $1, I think.
$3.70, to 68 cents.
68 cents, there you go.
So it was like down like 70%.
But I actually think it's back up around $17, $18.
So $20.
$20, there you go.
So maybe, you were right about buying it when it was down and out.
Maybe.
You just needed to hold on another 12 to 13 years.
Well, there you go, long-term investing.
Yeah, that's it, yeah. Okay, so that's good. So watering your weeds and not your flowers, I like that. Number 3 of my planted questions is, what's been your biggest success? So we just talked about the mistake. Biggest success, and what did you learn?
The biggest success that I've had, and this is another company that I own shares in, WiseTech Global. Now, this is a company I think you're also quite familiar with.
Yeah, I do own shares in it for disclosure, yeah.
Yeah, really great business. Okay, so first of all, you might be familiar with the short report that came out on it maybe 7 years ago, I want to say.
I would be, but listeners may not be.
Okay, so there was a short report that basically, it basically called out the company's entire business model. This short report, which basically says they think a company's shares are overvalued and should be valued at less. That's essentially what a short report does. But it called out that this company was undertaking way too many acquisitions. Its accounting was very unclear. Therefore, the whole business was pretty shoddy. Now, when that report came out, the stock fell about 25% or thereabouts. And I think after that, it continued to fall as well. And look, blood's in the water at this point, right? People are selling, people are panicking. What I really learned from that experience was just the art of patience. So actually looking into the report, understanding what they're saying and thinking through, okay, no, I don't agree with this thesis or this basically sell thesis. I believe that the company's acquisitive strategy is actually quite misunderstood. Because one of the things that this short report called out was that a lot of the acquisitions that the company undertakes actually end up losing revenue in the next few years. So they experience a decline in growth. But realistically, that's actually part of WiseTech's strategy. They've been very clear along the lines that is part of their strategy. Because what they do is they undertake these acquisitions, they then integrate that business into its own business model. So they might go from like a legacy traditional sort of payment method to more of a SaaS, software as a service model, where it's sort of paid by usage. Now, in the first few years, it actually undergoes a little bit of a decline, but then as it becomes part of the CargoWise platform, which is what WiseTech is most widely known for, it actually starts to really benefit the entire platform and all of its users. That was the company's overall long-term strategy. And I think that was really misunderstood by the market at that point. Now, the shares have gone up a long way, even since before that report, but certainly from the trough of that report coming out, the shares have just gone bananas.
Yeah.
And again, that's not to say that we only want to focus on what the share price does, but the business itself has done phenomenally well.
So it fell from $29 to $13.
Yeah. Yep.
So more than halved. Did you buy more shares at that time, or were you just like patient and just holding on?
Personally, I haven't. The reason being, I don't know if it's actually my largest position or my second largest position. And I think at that point in time, it would have been my largest position. So I suppose I didn't want to go overs and become overly concentrated in it. I think for the services that we run, I'm pretty sure we did buy more. This is, as I said, this is going back about 7 years, so I can't remember specifically. But off the top of my head, I think we did.
Yeah, and you guys at the Motley Fool are known for ultimate transparency. So you're also, there's like a lot of rules around this, but you have to basically eat your own cooking as well, right?
Well, we can't, okay, so we can't sell something that we have a buy recommendation on or a hold recommendation, but that also doesn't mean that we have to necessarily buy what we recommend.
Yeah, okay.
Yeah.
But that would mean that if you held it and it was still a buy,
I couldn't sell.
Yeah,
precisely.
So yeah, you're kind of in it, in the trenches as well. But good for you, because WiseTech is up 2,600%.
Yeah. It's done phenomenally well. And that's actually down about, I want to say 25% off the highs.
Yeah.
Yeah, the company's had a few governance issues recently, which, look, it's not been pretty. I'll be the first to admit that. But the company itself, I think, is still very well positioned for long-term growth. And that's what that's ultimately what I'm looking for.
I remember I went on TV and I said that WiseTech shares were expensive at $20 a share. They're now $107.
So do you stand by that advice?
That's crazy, because I bought shares like a month ago. It's like $75, which I'm still happy about because I made like 30% in 2 months. But
one of the things that I wonder about WiseTech, though, it's listed on the ASX.
Yeah.
What if it was listed on the NASDAQ? Do you reckon it would be worth a lot more than it is today?
The whole company's worth $36 billion Australian.
Yeah, so
I reckon if it was in America, it would be worth $24 billion
US dollars.
I reckon it would be worth double.
Yeah, I can't.
I reckon the Americans would love this company more than Australians do. Yeah.
Yeah, it's just got such phenomenal metrics behind it.
Anyway, so the lesson learned is to be patient with good companies. Like, focus on the company, not the share price.
Yeah, yes, but even more fundamental than that, focus on the thesis.
So the reason that you bought it.
The reason that you've bought it, and understanding why you've bought it, understanding the reasons that you might want to sell or what might actually break that thesis. So again, the acquisitive nature of WiseTech wasn't something that I was overly concerned about. I mean, sure, I wanted to read what the short report had to say. I wanted to make sure that I'm not, completely misunderstanding or completely misjudging the business.
Yep.
But I also didn't respond to the panic. And I think that was a real lesson learned for me. And I would hope a lot of investors learn from it as well, even if they did sell out at that point.
So you bought it like very early days, right?
I actually think I bought WiseTech shares maybe within the first week or two of it being a public company.
So that's like $4.
Yeah, I think it was. I think my buy price is around $3.80 or something like that.
Holy macaroni.
Yeah, I hate to admit that I haven't actually bought shares since then, but it's done phenomenally well for me.
Holy heck, my man, that's really good.
Yeah.
Well done.
Yeah, but I guess that's another lesson as well for listeners, is that it was a fairly small position when I bought it because, how long ago since it IPO'd?
2016.
2016, so nearly 10 years. I didn't have a huge portfolio at that point, but I guess you don't need to buy a huge position in something. If it does well, it can actually make some very, very meaningful returns for your portfolio.
Well, I don't know what you invested, but even say you put $2,000 in, I don't know, $5,000, I don't know what you would have invested, right? If it went from $4 to 107, that's like, if my math don't serve me.
I think it's a 26 times return.
26 times your money.
Yeah, there you go.
Oof, your shout for lunch.
I'll keep that in mind.
Number 3.
Did I say I bought that then?
yeah. No, I'm going to sell it.
Yeah.
Number 3 is, and this is, I know, something you think about a lot, because you're like you're kind of in this world of like educating investors. You're a professional, but you have thousands and thousands of people that follow the Motley Fool and what you do. My question is, are there any particular tools or resources you would recommend for beginner investors looking to level up with individual shares?
Yes, there are. I would say, first of all, I am quite narrative based in my companies, the companies that I research. I'm not purely quantitative. I don't purely look at the numbers. I want to understand the business itself. I think, first of all, one of the best tools that investors can make use of is simply the annual reports that companies put out, the presentations as well. Mm-hmm. You want to make sure that you're not leaning into the biases laid out by management. Obviously, if they're presenting, they're putting things in a presentation, they're actually writing reports, they're going to be making a pretty positive case for the company and for the investment. That's what they're there for. So I think you do need to sort of keep that skeptic hat on to an extent. But that said, the annual reports, the presentations, they're a fantastic resource to actually start to understand a business and what it does. I'm not just talking about the last annual report, maybe go back 5 or 6 years. Understand, again, where the company's come from, its strategy and how the company has actually followed that strategy. Has management been true to their word, to what they said they were going to achieve? And then understanding where they are today, what their strategy is today. So I'd say annual reports and presentations for starters. Quarterly calls, a lot of companies on the ASX provide semi-annual or annual earnings calls. So that's probably more what you'd be going for. But listening or even just reading the transcripts, understanding, getting, I guess, more insight from management about what the business has achieved, providing a little bit of extra context. You'll often find as well that analysts have been asking questions that you may not have even thought of that can actually just give you a few tidbits to understand the business that little bit better. I'm also going to say the Motley Fool is a great resource. So as you mentioned at the start, I'm the Director of Research for the Motley Fool Australia. But on the fool.com.au website, and this is all free for investors to actually access this as well, but there is just so much coverage about companies. And it's long-term oriented as well. So it's not just looking at what has this ticker code done today. Being down 3% or being down 0.5% is what some outfits will report. But it's actually looking at the business itself, understanding their announcements, what's actually new about this business. So I'm eating my own cooking here, but I would say the Motley Fool is a very good resource for investors to use. Yeah,
like the fool.com.au website, I'll bring it up here for anyone that's watching, has loads of free articles, fool.com.au. You can subscribe to the free newsletter. You can pay for one of the services.
So it's individual shares. You'll get some US news on there as well, but also macroeconomic. I mean, I would say most of the investing team aren't overly focused on the macro side of things. We are much more focused on the micro and fundamental investing.
Yep.
But it's a good source for people to go to understand inflation, interest rates. There's some educational content on there as well. So it is a good resource.
And you can actually get the announcements, can't you? Yeah, the company announcements on the Motley Fool website.
Yeah, you can see what the company's done in terms of its shares. I think you can see the liquidity of the shares as well.
Yeah.
For people who
see who the directors are. Yeah. All that sort of stuff. Oh, that's cool. I didn't know that directors and the management team bios and stuff are on there. That's cool.
The editorial team are doing a fantastic job over there. They're doing a wonderful job and bringing a lot of good information.
Yeah, cool. Okay, great. So, we've gone through those planted questions now. I was hoping that you could bring us 3 companies for an exciting future.
Sure.
So we're talking here about, investing optimistically, investing for a great future. Like you mentioned WiseTech that solves shipping problems and not something that a lot of us would have exposure to, but you mentioned Xero, which does accounting. Mm-hmm. I'm happy to spend a couple minutes on each of these, and I would probably just say to people, chuck these on your watch list, go and read the Motley Fool website if you want more information, or even send in some questions because who knows, we can even invite Ryan back on. I think maybe once every 3 years is probably enough, but if we want him back.
We get sick of each other.
No, I'm kidding. But mate, I'd love to know wherever you want to go. I'm eager to talk about. I don't know what these companies are, so
sure.
Bring them on.
All right, first of all, I will go with Resmed. Okay. Now, Resmed trades, but actually it trades on the ASX, but also the New York Stock Exchange.
It does indeed.
So it's dual listed. Ticker code is RMD.
Yep.
And the company is basically a global leader in sleep apnea devices, digital respiratory care as well. So sleep apnea, for people who aren't aware, it's basically a condition where overnight your throat can sort of close up because of a lack of pressure. And, it might not sound, I guess at its core, people say, look, it affects your sleep. Yeah. That's not great. And that isn't great. But it's so much deeper than that as well, because the health implications that come from that are horrible. So heart disease, higher risk of stroke, even car accidents. If you're tired in the morning and try to go to work, and it's not ideal. So this is a real problem though that needs to be solved. And there are hundreds of millions of people in the world that suffer from sleep apnea, many of whom don't actually know that they suffer from sleep apnea. If you snore, if your partner says you snore, there's a chance maybe you might have sleep apnea or some sort of underlying issue there. And that's the kind of problem that Resmed is really trying to solve. Resmed has a business model where they sell the device itself. So the CPAP machine, which is continuous positive airway pressure. And it's basically a device that pushes that air into your throat overnight. The technology's come a long way as well, right? 10, 15 years ago, I couldn't bear the thought of having to sleep with something like that overnight. But the amount of development and research that goes into making these things more comfortable to improve people's usage of it is incredible. And my understanding is that these devices are actually very quiet, very comfortable to use now. So real progress made there. In terms of why investors should buy Resmed, I think there's a couple of really powerful trends that are working in the company's favor at the minute. There's also an overhanging threat, which I think has been blown out of proportion.
Okay.
Ozempic.
Just hold that thought, because I was going to point your attention to this here on the...
Yeah, for anyone who's watching can see this on the screen.
Yeah, in 2023, it was falling, and it fell from, what's this range? Like say $35, and it fell down to like 20s.
Look, yeah, so that dip around there.
Yeah.
Where is that? Around October 2023, is it?
Yeah.
Yeah, so that's roughly when we bought the shares.
Oh, right.
Because GLP-1 drugs, it's basically, I can't even remember what that actually stands for, GLP-1.
You're asking the wrong
I'm
fella.
not a scientist, but essentially it's drugs like Ozempic, which are designed for, they were initially designed for diabetic treatment. They're still used for diabetic treatment, but there you go. What is it? Glucagon-like peptide 1.
Okay. Surprised you didn't remember that.
Oh, me too, yeah. So essentially, drugs like Ozempic.
Yep.
Obesity is thought to be a key contributor to conditions like sleep apnea.
Yep.
And the thinking was, the bear case was that as more people start to take Ozempic, less people will be obese, which means less sleep apnea, which means less demand for Resmed's devices. Now, I think that's a logical way of thinking to a degree.
Yep.
But I think it was also flawed in thinking that there is only one way that this could possibly go. Because what is ultimately happening, and the company has a lot of statistics behind this, they're doing a lot of research, as you could understand, to make sure that they're still heading in the right direction with it. But people who are taking Ozempic and also using CPAP treatment are actually finding they're experiencing far better results. They're also found to be far more compliant with their treatment.
Interesting.
And I think one of the key reasons for that is because these are the people who are actively looking for ways to improve their health. And they're willing participants in Resmed's treatment to do that. So I think that's one of the mega trends really that is driving Resmed's growth, but I think will continue to drive Resmed's growth in the future as well. The other one as well is smart devices, so wearables. So I wear an Apple Watch. I don't actually wear this one overnight because I do need to charge it. But the Garmin's, things that can last 4 or 5 days, the battery. If you wear that overnight and it can detect any issues with your sleeping patterns, then things like that can actually send you alerts like, hey, you might want to go and get tested for sleep apnea. Just that raised awareness, I think, is a really powerful tool for Resmed as well. Over time, I think that can really help convert a lot of that community who is currently suffering from sleep apnea but don't know it.
Fascinating. I remember writing about Resmed at the time because this is like one of the ASX's best companies of like the last 10 or 20 years.
Oh, it's done a phenomenal job, yeah.
And I was thinking, how often do you get a chance to buy shares in a company that's like a healthcare company, that's global, that's proven itself over decades? And people got that opportunity. I'm glad you guys made that recommendation.
And look, GLP-1 drugs, they are still a threat. I don't want to say that they're not.
Yeah.
But I also think they're an opportunity. And I think that's a good reminder that to use that second level thinking, to not necessarily automatically follow the crowd, off the cliff, but to understand what is actually happening and what do I think is likely to happen.
Yeah, cool. All right. What else you got for us?
Second company I will talk about is Gentrack. Now, this is a New Zealand-based company.
Gentrack.
But trades on the ASX with the ticker code GTK.
Okay.
It's a software company, provides mostly mission-critical solutions. And I love mission-critical elements to businesses. Mission-critical basically means that the product or the service, it sits at the very core of what a company does or what a customer does. Mm-hmm. They couldn't function without it. So think billing software, for example, or customer relationship management. If you were to try and tear those things out of a business processes, then it could really, really interfere with their processes and how they're actually functioning. So Gentrack, two different businesses. The first and more major one is the utilities business. And look, it's mostly software solutions. They do also provide some managed solutions. So for instance, running billing, fixing data, reconciliation of payments as well. But it's basically helping to bring utilities businesses, in particular, energy businesses, but also water businesses, to come into the future, to be modernized into the sustainable era. So the current industry standard, what you'd find most utilities players using are legacy solutions from the likes of SAP or Oracle, for example. And these software solutions are really designed, I suppose, to work across basically all utilities businesses. They're very basic. They're used predominantly, I suppose, for a unidirectional flow of the utility. And a good example of that, let's say you've got the grid, you've just got electricity coming from the grid to my house. Someone will then come out occasionally and check the meter to make sure, to check how much I've actually used.
Yep. That's
unidirectional. But think about how the grid and how the, I guess, utilities businesses are really evolving.
More solar panels, batteries, batteries,
electric cars. You've got EV chargers everywhere. There's so many more functions that these things need to take into account. So it's no longer unidirectional. It's now multi-directional, where the information needs to flow in all different directions. Now, the legacy solutions from the likes of SAP and Oracle, they're not equipped to deal with that kind of information. So these solutions are really, I suppose, coming to the end of their useful life. Mm-hmm. What Gentrack has done is develop this other software called G2.0. I don't know how they pronounce it exactly. I guess it's just G2.0. Mm-hmm. Essentially, though, what it is, it's a world-class solution designed specifically for the energy businesses and also water businesses. It's hosted on AWS as well, so Amazon Web Services. Mm-hmm. It controls a lot of the core functions that these businesses are going to need to undertake. So billing and finance solutions, distributed energy and resource management, customer experience as well, because they've got a partnership with Salesforce, which is the world leader in customer relationships management software. I'll just give you a really brief example. There's a company called Genesis in New Zealand, and they have what is called the Everywhere program, EV in capitals, everywhere, specifically because it is focused on electric vehicles. Mm-hmm. Essentially, what they've done is they have used Gentrack's G2.0, to allow Genesis users to basically charge their electric vehicles outside their home, so at a shopping center or at any other bay as well, and to do that for free by just logging into their app. They can actually just get that added to their own personal bill.
Ah.
Yeah. And if you think about it, a utilities business was actually trying to use, as I said, one of those legacy solutions like from SAP or Oracle, they couldn't possibly do that with that technology. Mm. And if you're trying to come into the sustainable era and you're trying to compete with other utility providers, then you need to be on that latest software that is actually capable of doing that. Gentrack's actually also really well known for its ability to integrate these systems basically with 100% accuracy. I don't think they've actually had any major failures. Mm-hmm. And as I said, being a mission critical solution, a core functionality to these businesses, very ability to continue to operate, that is incredibly important. So a lot of these businesses are going with Gentrack.
I've just got it here on the screen. So an example of a customer would be like Red Energy, if people are familiar with that. Yeah, here in Australia, but they're like global. Yeah. So That's cool. So GTK.
I'll just mention quickly as well the second part of its business.
Yeah.
So it's quite separate and it is managed very separately, but it is also still very mission critical. It's actually for airports. So it's called Viovo is the name of this business. Essentially as well, it's software to help airports modernize. So we saw a lot of airports actually start to implement this through COVID. When crowds were down, they were trying to, manage their airports and manage their operations better. And they found that was a pretty opportune time to actually start to implement those solutions. But the software is used to help improve the traveler experience. So, for instance, shorter lines, less congestion, improved passenger flow. These are all things that can really help to improve the customer experience. And a lot of airports are starting to take this solution on as well.
Okay, cool. So it's got like two businesses in one.
Two businesses in one, yep.
Like it. That business in the half year made half year made $19.2 million of revenue, that one for the airports, and the other one made $93 million, both growing, which is great. So cool. Okay, GTK. That means, I believe, if we're at 2, I think you owe me one more.
I do indeed owe you one more. I'm going to go with Pinnacle Investment Management.
Okay, cool. This is one we haven't really talked about on the finance podcast too much.
Yeah, nice. Okay, so Pinnacle Investment Management, ticker code is PNI. Look, I will say one of the things that really drew me to this, and I was really curious about this when I saw it. I looked at have you ever looked at the income statement for this business?
No.
Okay, so most companies, as you know, the revenue line, might say, let's say $100 million, and then progressively gets lower and lower and lower until you get down to the net profit line. This company really stood out to me because its net profit is regularly higher than its revenue line.
So you're saying that the profits are higher than the sales?
Yes, its net profit margin is more than 100%.
So that you'd be like, well, how can you have more profit than you do in sales?
Exactly. Now, the reason for that is because there are two distinct parts to this business, but they're each entwined with each other. So they're both reliant on each other's success. So the first part of the business is essentially Pinnacle provides critical functions to boutique funds. So we're talking marketing, distribution, those sort of things. Mm-hmm. This part of the business is mostly run to break even. I don't know that they've ever really made too much of a profit on it because it's really just a supporting strategy, I suppose, for the second part of their business. Mm-hmm. The second part of their business is to take an ownership stake in a lot of those affiliates. In fact, almost all of the affiliates that it provides those critical functions for, it also owns a stake in. Typically below 50%. I don't think they've actually got any ownership stake where they're above 50%. So it's typically a non-controlling stake. Mm-hmm. But essentially what it does is it arranges with these funds that we will provide you with this functionality, the marketing, the distribution. We will also own a portion of you. And in return, you obviously pay us a portion as a distribution. And that is essentially how the company is managing to make a higher net profit than revenue, because the revenue line is from the functions that they're providing, the marketing and distribution. Further down the income statement, they're also getting the gains recognized from those payouts.
Okay.
So it's a really interesting business model. But in terms of Pinnacle itself is really highly sought after by funds in the industry.
So potential partners want to work with them? Potential partners want
to work with them because they've got that name behind them. They've got that reputation for having that strong outfit, the ability to market and develop, the ability to market and distribute the products effectively. And that's really important as well for the ratings agencies to recognize. So particularly when you're starting to deal with superannuations or other industry funds, for example, for them to be investing in funds, they need that I guess the ratings agency to give them a thumbs up to say, yep, this is all good. We like this fund too. And because Pinnacle has those relationships with those ratings agencies, the likes of Zenith and Morningstar as well, it stands a better chance of actually getting that good rating. So it can actually really enhance their ability to attract funds.
Yeah, for sure. That's it's a really cool business model because they own part of the businesses that grow really well.
Yeah.
And they, in exchange, get like a very small part ownership in that. And so they increase the chances of that business being a success. Yeah. And by doing that, then they can kind of tag along and share in the success. And we can see here for the most recent reporting period, Pinnacle reported $49 million of revenue.
Yep.
And then total profit for the period was 90 million.
So nearly twice. Yeah.
Yeah. Wow. I don't think I've seen that anywhere else.
No, I don't think I don't want to say it's unique to Pinnacle, but you wouldn't see that on many companies on the ASX.
Yeah, and that's because just for people that are unfamiliar with accounting rules, basically because they don't have the full share of the ownership of the companies that they are part of, they can't record it on their own income statement as revenue. They have to record it as equity, but I won't go too far into that. So really interesting business.
Yeah, and the funds or the boutiques that it's affiliated with, they're also spread across different asset classes. So you can be gaining access to equities, to bonds, to property, international equity as well, private markets. So there's a lot of diversification in there too, which I think is really handy to have as investors on the ASX.
I like how you progressively with the companies that you brought to us today, Resmed, Gentrack, and Pinnacle, you kind of started off with the easier to understand one, and then you went to the middle one that does utilities, and then the final one that's like more kind of nuance in the way you understand it. Did you do that on purpose?
I didn't do it on purpose, but I'll take it.
Yeah, okay.
I'll take it.
Okay, you did well, mate. So we've got Resmed, RMD, Gentrack, GTK, and
Pinnacle, which was PNI.
PNI. Mm-hmm. Okay, cool, mate. These are really interesting. So put these on your watch list. Head to the Motley Fool website if you want, fool.com.au, to find out more about these three companies. So you mentioned to me off air, you guys, you have the paid services, which is what you work on. You work on the premium, the back end secret sauce. Which memberships do you work on?
So the two services that I directly work on are Motley Fool Pro, which is permanently closed to new members.
Yeah.
The one that is regularly open to new members, though, is North Star.
North Star.
Now, my understanding is that is going to actually be open for new members, I think in July.
Okay.
I don't know when this is going to air, but I think in July. And typically, I think we only actually market that to people who are actually a member of one of the other services. So, for instance, Share Advisor or Dividend Investor. Mm-hmm. That said, if any of the listeners are interested in joining, then by all means, I'd encourage them to reach out to our member services team just by finding the email on our website. Mm-hmm. And yeah, I'm sure if you mentioned that you are interested in joining North Star, you can also join when that does reopen. Yeah, cool, man. Well, this has been heaps of fun. So, Ryan Newman, Mr. Director of Research of the Motley Fool, coming all the way down here into the CBD of Melbourne. We really appreciate you coming in and talking about this. Who would have thought us scallywags back in the schoolyard and we'd be sitting here together talking finance? Well, who knows? Yeah, who knows where we'll be in another 15 years. But, mate, it's always good fun, so I appreciate it. It is. Thanks for having me. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.